In this ongoing series, we continue to build our total return TFSA from 0 to 100K. Even as stocks were falling last month, there sure was a lot of great opportunities to bank some future returns. Hold on to your seatbelts, folks. This is going to be a good one. As we reach our 10th month in the challenge, we have a total of $5,199.49 invested into that TFSA. $500 is added each month as a base amount, and we also take any super chats, thanks, or stickers from the channel and add that to the pool as well. So far, you guys have contributed a total of $200, so a huge thank you for that support. The theme of this month is buying stocks on the cheap. When the markets are in the red, there's often some very good opportunities to capture some discounts on our favorite stocks.
Candace, how do I know it's a good deal?
That is a great question. For a new investor, using the adjusted cost base, or ACB, is a great place to start. The ACB is often listed as the average price you paid for each of your individual stock. If you look at your current price on a red market day and it is lower than your average price, then buying more will lower that ACB. This is often referred to as averaging down your investment. This is pretty straightforward when you are a new investor, but once you have spent some time in the market and your investments have had some time to grow, a red day may not break below your ACB. For example, my ACB on Hammond Manufacturing is at $8.87, which is really a really good entry point for sure. However, HMM.A, well, they made it up to $13.97 in February. They have begun a correction that has now taken them all the way down to $11.01. Despite not falling below my really good ACB, this is a company with good fundamentals and a lot of potential to regain those losses in the future. So yes, it is a great buy, even though it averages me up a wee bit. That, of course, is just one example, but I have a few general rules of thumb for buying the dip. The first and most important rule is to understand the context of the fall. A correction or a slight market downturn is absolutely completely different than a rapidly declining market with no signs of recovery. The latter is often referred to as catching a falling knife. In that case, where the market is just not looking very healthy at all, that is the time to consider keeping a larger cash position and wait for signs of recovery before you start adding to your favorite positions. Some investors even like to use a hybrid cash dollar cost averaging / buy the dip scenario. So how that works is that you create a plan where you drop your money into your cash position initially. Then if the price on your favorite stock drops 10% in a correction, you can then spend 20% of the money to add to your position. If it drops another 10% down to 20%, well, then you can spend another 40%. Basically, you are dollar cost averaging the dip. These are just example values. You can, of course, play with the math for sure and find numbers that work for your risk level and strategy. Join today's conversation. Let me know in the comments your red day strategy. Thank you for your participation. If you love this sort of content, be sure to subscribe for more, and another huge thank you for that. Click. All right, let's get into the challenge portfolio. We will begin with the stocks that we have not added to in this cycle. So we have Alimentation Couche-Tard in the red at a total return of negative 1.54%. Scotiabank sitting at 7.30%. Canadian Natural Resources, look at them, up there at 25.44%. This could be the one to beat. We also have Canadian National Railway at 11.43%, which is definitely not too shabby. Canoe EIT is sitting at 9.09%. HXQ is at negative 0.23%, and QQCC at negative 0.70%. So HXQ is still winning the covered call versus non-covered call side challenge. Not by a lot, but they're still winning. We have Sir Royalty at negative 13.25%. This one pains me a wee bit, as I have had so much faith in this company. I still do. Let's switch gears and look at the stocks we have added to this time around. First off, we have Brookfield Asset Management. We added one more share for a total of 8 shares. And that does take us to a 7.77% stake. Their current price is coming in at $52.61. So far, we have received $6.09 in dividends. So that gives us a return on investment of 7.35%. Factor in the dividends, we get a total return of 8.90%. BAM struggled a wee bit in April, but they stayed above board, and I'm still very bullish on this stock. Next, we have Bell Canada, and we did add another share to bring our total up to 8. They currently sit at a 6.65% stake in our portfolio. Their current price coming in really low, $45.07. We did receive $5.99 this month in dividends. Their return on investment not looking good, negative 6.28%. Total return comes in at negative 4.72%. BCE edged down even more this month. I still feel like the bottom is near, so hopefully I am right about that, and we see a reversal in their fortune later this year. The first of 2 new stocks is Bird Construction, and we opened a new position in them with 3 shares. That gives us a stake of 1.06%. Their current price at the time of recording was $19.19. We have not yet received any dividends, but we do have a return on investment of 1.86%. Same number for your total return as well. I have very high hopes for this company, and it is funny enough that I gave myself a kick in the butt to open this position after I researched them for one of our list videos. We added another 2 shares to the Purpose Bitcoin Yield ETF for a total of 42 shares. That's a 4.64% stake. Their price, it's down to $5.98. We did receive another $2.10 in dividends, giving us a total of $5.86. That return on investment, more than half of what it was the last time. It's coming in at 14.34%. Total return after we factor in the dividends, 17.01%. Bitcoin had a pretty rough month, and as a result, this ETF followed suit. I still have high hopes for the rest of the year. Of course, looking at that number, you know that BTCY has given up the go toward this cycle. I wonder who's getting it. Up next, we have Decisive Dividend Corporation. We did add 2 more shares for a total of 25. That brings their stake up to 4.31%. Their current price sits at $9.34. We added another $1.04 in dividends for a total of $5.74. Their return on investment sitting at 5.42%. Factoring in the dividends, we get a total return of 8.01%. DE did slip a fair amount in April, but overall, they are still okay, and I still have high expectations for them. Our next stock is Diversified Dividend Corporation, and I added 12 more shares, taking us up to 32. They have a 1.66% stake in my portfolio. Their current price sits at $2.81. We did receive 62 cents in dividends, taking that total up to $1.02. Their return on investment comes in at exactly 0%. Kind of funny, but they do have a total return of 1.16%. I do still love this little stock, and let's see where it takes us next month. Fortis is up next, and we added 1 more share for a new total of 4 shares. That's a 4.04% stake in our portfolio. Their current price comes in at $54.69. We've thus far received $2.95 in dividends for a return on investment in the green, 0.31%, total return of 1.66%. It is very good to see Fortis back in the green again. Up next is Hammond Manufacturing, and we did add 2 more shares for a total of 25 shares. That's a 5.08% stake in my portfolio. Their price comes in at $11.01. We did add 63 cents in dividends, taking those dividends up to 81 cents. That return on investment sitting at 24.13%, total return 24.49%. Hammond had a rough month, but even still, they are still one of the best in the portfolio, and I do expect a good year overall for this stock. We added 6 more shares of Pizza for a total of 13 shares. That's a 3.20% stake in my portfolio. Their current price sits at $13.36. We did receive another 54 cents in dividends, taking that total up to $1.32. Their return on investment sitting at negative 4.91%. Total return after we add in the dividends, negative 4.19%. Their sector is hurting, and I am patient, and in fact, this was a good average down opportunity this month. Up next is Ryokan, and we added 1 more share for a total of 11 shares, taking them to a 3.61% stake in my portfolio. Their current price sits at $17.78. We received another 93 cents in dividends, taking those dividend total up to $2.29. business. Their return on investment, 0.40%. Total return sitting at 1.57%. I am still looking forward to better days for real estate in the latter half of this year. Next, we have Timber Creek Financial. I added 4 more shares for a total of 15 shares. That takes them up to 2.08% stake in the portfolio. Their current price sitting at $7.51. We did receive another 63 cents in dividends. That takes that dividend total up to $1.61. Their return on investment, 0.94%. Factoring the dividends, we get a total return of 2.38%. Once again, this is one that's going to shine when those rate cuts finally arrive. Let's take a quick look at all of them together so we can see how that portfolio is taking shape. We have a portfolio real total return of 6.25%. So you can see we took a hit in April, but that will come back. Let's take a quick look at the portfolio's diversification with the Blossom app. Link down below if you are yet to try Blossom. I try to limit each sector to a maximum of 20%, though I am usually not worried if I go over a wee bit. Well, look at financials. They're up to 29.8%. I really do need to pull this one back a wee bit as it is well above that 20%. We've got industrials at 19.6%, consumer cyclical at 17.4%, energy 9.6%, communications at 8%, technology at 5.9%, utilities at 4.3%, real estate sitting there at 3.9%, consumer staples at 0.8%, healthcare sitting at 0.7%, and materials bringing up the rear at 0.1%. Holy banana bread. I do want to see those materials improve. Next month's stock buys will absolutely be taking these numbers into consideration. And of course, if you're wondering, that second number in orange, that's the average across all Blossom users. It is time to look at the toad and the goat of the portfolio for the last month. The infamous Toad Award for our worst performer of the month is going once again to Sir Royalty with another disappointing total return. Come on, Sir Royalty, you can do better. Now for this month's goat, and we have a returning goat. Canadian Resources eked back into the coveted title with a 25.44% total return. It was very close, as Hammond almost reclaimed the title with their 24.49%. Next month will be epic as these two superstars battle it out, and well, BTCY may have a different plan, so you gotta tune in for that one. So that is our update for this month, and we'll be back here again next month to do it all over again. I sure am looking forward to buying the next batch. If you are interested in any of the stocks we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on YTSL. Thank you for watching, and I will see you in the next video.